Hello, everyone. Hi, welcome. Welcome to the Nature Tech Collective. Welcome to the Nature Tech in Action. We're slowly letting people trickle in, and I'm going to go into the introduction. The Nature Tech in Action is a webinar series from the Nature Tech Collective. It showcases case studies in nature tech, mostly from our community. Our community are 180 plus organization across the spectrum of nature tech. They're the ones that are measuring the health of nature, that are restoring nature, that are helping finance funds towards nature. So we've got an incredible stakeholder mix that's distributed across the nature tech ecosystem and across the world. And so these sessions are moments for us to just share that knowledge, share challenges as well, have conversations about what's working and not working in nature tech, what's surprising, what's interesting. They're gathering as much of, deep technical nerds as well as people who are here to learn about what's possible. So thank you so much for joining us today and asking questions as you registered. We're going to be using some of them. And here's the run of show is going to be basically, we're going to start with a very short introduction about the thematic of this webinar. And then we're going to go into a sort of fireside chat. There's going to be a few slides associated. And at minute 40, or no, in about 40 minutes, we're basically going to go into the Q&A. So I'll use both the questions that you've submitted and the questions that you can just raise your hand with after the webinar, after you've potentially got more information. And so the subject of today, you've probably heard this kind of turn of phrase. Every investment is a hypothesis about the future, and every future ultimately depends on nature. Today, we're looking at an analysis of the 100 largest companies in the Nordics to understand how they truly interact with the ecosystems that underpin their value. Joining us to help navigate this is Anupam Ravi. He's the Chief Commercial Officer at Just Impact, and he's going to tell us about this really interesting collaboration with Storebrand. Together, we'll explore a report and what the Nordic called, I can't remember what the report is, and what the report calls the Nordic paradox, the finding that while these companies frequently outperform their global peers, their overall footprint on nature continues to grow year on year. We'll pinpoint specific sectoral hotspots, such as manufacturing's high exposure to water stress, and we'll examine the critical intersection of corporate assets with indigenous Sami territories. At its core, this session is about how science-based metrics, like the potentially disappeared fraction of species, are being used right now to shift corporate strategy from simple risk management to long-term resilience. For decades, we've understood that environmental destruction is happening, but identifying exactly which organizations are responsible and where has remained quite elusive. Data availability and quality are often cited as the barrier, and so this report dismantles that excuse. Using available data, it demonstrates that it is possible to pinpoint which organizations are driving impact and where action is the most needed. So Anupam, please tell us more. Please introduce yourself and a little bit more about Just Impact before we go into the depth of it.
Thank you, Paige. Hi, everyone. Good morning. My name is Anupam Ravi. I'm based out of London. I've been with this company called Just Impact for close to 10 years now. In my role at Just, as of today, I'm Chief Commercial Officer, but I've been doing research for quite a long time. In fact, I was heading research for the firm for almost 8-9 years. And I've spent like 15 years on this topic of nature, especially natural capital as a topic, looking into business externalities, which is third-party impacts of businesses on society, on nature, and how do we quantify it? How do we value the positive and negative contributions which the company does as a part of their day-to-day operations, generating revenues, generating profit for the shareholders. But what is the value which is eroded or added for the wider stakeholders is what my focus has been over last 15 years. And for today's session, if I can give a very quick context to this Nordics 100 study, I mean, I would say the idea came up, and we'll talk more in the details of the study itself, but I think it's one of those very good reference reports out there, which covers the entire spectrum of the TNFD LEAP framework, which is locate, evaluate, assess, and perform framework. And we had a lot of conversations with TNFD as well and with financial institutions. There's lack of enough reference case studies that how it can be done, what exactly should be, how it should be approached. And I think in this report, if you get a chance to look into it, you will find that we have actually addressed the multi-dimensional issue of nature. It's not a single dimensional issue. We have covered all the key dimensions, looking into the sensitive locations, looking into impacts, looking into dependencies, also adding a layer of analysis on the social aspect, which is so critical when it comes to nature. So I think it's from a comprehensive standpoint, it is a very good reference case study. There are a few case studies out there, but TNFD have even used this as one of the reference studies on their website. So we'll talk more about this study and what was the purpose and the details as we speak further. Back to you, Paige.
Yes, well, thanks for that context. And yeah, let's just take one step back and ask, how did the partnership begin?
Yeah, I think you briefly touched upon this point, Paige, in your introduction. I think one of the key reasons for this partnership was this idea that there's lack of data when it comes to nature and looking into nature assessments, um, which was actually bothering both Gist and Story Brand, because we have been collecting data since quite some time. As of today, we cover more than 20,000 listed entities across the globe, and we can do private entities as well. We have historical data for last 8 to 10 years, and a lot of data is actually company published information, but we would combine that data with a lot of on-ground data, which is collected by big NGOs. There's a lot of satellite data which goes into the analysis. So we feel that there's plethora of data which is already available, which covers multiple dimensions. As I pointed out, there are multiple dimensions to nature and biodiversity, and we feel that there's enough data on each of these dimensions. And when we got in touch with Emilia in one of the conferences in London, she raised the same point that she strongly feels that data should not be a limiting factor in today's world, for companies to not act, and even financial institutions to not pursue these kind of analysis, and tilting their portfolios and decision making, especially integrating nature into their decision making, is fundamentally what we are aiming for. So it was kind of a natural fit for both the organization, and we wanted to use Nordics 100 as a case to highlight. Obviously, Storybrand is an asset management firm operating in that geography, so that was their key focus. We use Nature Action 100 as a benchmark, using the same kind of approach which a typical financial institution would use. They would look into their portfolio. They will always use a benchmark to see the performance, especially on the financial performance. So we wanted to use a reference, which is Nature Action 100, very well accepted list of top 100 companies which are known to have problems related to nature because of the nature of the operations which they have, the kind of business activities in they operate. So we use Nature Action 100 as a reference, comparing Nordics 100 companies using criteria which has been laid out by TNFD to select these companies, which is essentially, whether these companies are operating largely in business activities which are known to have problems with nature. Are these the top largest companies? So there were some very basic steps which we took to filter these top 100 companies, and then the analysis was to focus on all the dimensions which TNFD LEAP process highlights. Yeah, I'll pause there. Back to you, Paige.
Um, Thank you, Anupam. And I think, Shraddha, as well, you wanted to share a few slides as we go along and tell this story, so feel free to do that. But yeah, so you compared these Nordic giants to the Nature Action 100. I'm really curious from the report, what was the most striking thing that the data revealed about them?
Right. I mean, there were quite a few interesting insights which we got. First insight, and which was basically this slide. Um, as you can see, the performance of Nordic 100 companies is definitely lower, significantly lower, you can say, from the Nature Action 100 companies. Primarily given the fact that Nature Action 100 companies includes most significantly companies with most significant exposure to nature as a challenge. Um, but there were some very interesting insights which we were able to derive when we started doing some deep dive analysis. On this slide, as you can see, the impacts were almost 42% lower than the benchmark, which is Nature Action 100. But if we go to the next slide, Shraddha, this was a very interesting insight which we got from the study, which was um, if we look into the momentum or the time series analysis of the companies over time, what their performance has been in terms of how does these companies are impacting nature from the pressures which they are generating, and we are not looking into a single lens of carbon here. We have expanded the lens much beyond carbon. We would look into all the IPPS pressures except for invasive species, which is difficult to assess from a company's standpoint. Um, but we looked into carbon, we looked into water, we looked into any pollutants such as nitrogen, phosphorus. We looked into any land use change which the company is directly or indirectly leading to. And once we aggregate all those pressure categories, you can see that over time, the performance is, in fact, the pressures, the aggregated impact on species has increased by 1%. So I would say it has remained almost stagnant. But the real important point is that, we have normalized these numbers by market capitalization of the companies. So ideally, if we would, the ideal scenario would have been that, these companies decouple their growth to the pressures which they are generating, which is not what you see here. Uh,
Mhm.
and again, this is very important insight given the fact that we are dealing with Nordics companies which are known to have very good, strong governance and very strong control over the operations. Um, Still, they are not able to decouple their growth with the impacts on nature and biodiversity. So I think that was one very striking insight which we got. The other few insights which I would like to mention is that a lot of time nature impacts are only seen from land use change. And that's true for primary industries, whether we talk about mining and extractive or agriculture and food production companies. But that is not true for a typical a company like a manufacturing company or a chemical plant or a technology firm or a energy company. You will find that for these set of business segments, these business activities, it's not land use which drives most significant impact on nature and biodiversity. It's water consumption. Many times it's water consumption which is driving significant impact. Especially in Nordic's case, we've observed that nitrogen and phosphorus was quite a significant driver of the impact, given the nature of the business segments in which quite a few companies are operating, for example, paper and pulp manufacturing or seafood, agri-forestry, etc. So these, so there is a whole suite of pressures which is being generated, and land use is important, but more relevant for certain business activities, which got highlighted in the analysis itself. Paige, back to you.
That makes a lot of sense. Yeah, the threat of water scarcity is really interesting and of course surprising for the Nordics, but I hear that. I really interested also about the fact that the report looks at indigenous territories. Why was it important to include those social and legal risks as well into this nature finance study?
I think it's fundamental, in my opinion, to include social dimension to any nature analysis. If you look into um, um, natural capital is the biggest, I would say, it underpins everything, and social aspects are very interrelated. When it comes to indigenous land rights and indigenous population rights, I think they have been the custodians of nature. They are the biggest stewards of nature, and um, if land remains in their hands, we have seen it is protected, it is maintained. Um, One of the key insights which we got from this study is that, um, and this is again a legal, reputational, and operational issue for financial institution and companies. If companies have operations in areas which should be not um, touched. So, for example, if you see in this table, there is a 1A category which we highlighted, which essentially says that these are areas which should not have any business activity happening in those geographies or those biodiversity hotspots. But we found that there were almost 47 assets for these two key companies. Which were in fact operating in those indigenous land. Now that's a massive red flag. That why should a company has business activity happening or operating in areas which are truly protected? There should be no activities happening. There's definitely a issue with access to land and competing rights to um, uh, access to resources to indigenous population. So it was kind of an exclusionary principle from Storybrand's standpoint. They have a very strong principle that if a company has competes with the rights of indigenous population, they would literally exclude those companies from their portfolio. So it was actually highlighted in the analysis which you see on the screen.
Amazing. If I want to jump back up really quickly to kind of sectoral hotspots and which are the specific industries that stood out as being particularly exposed to nature risk. You talked about it a little bit. Um, but yeah, how are
Yeah.
you measuring that as well?
I think I'll use this chart to demonstrate how we arrive at those hotspots. As you can see in this chart, on the x-axis, basically the numbers represents how significant is companies' impacts on biodiversity, which is represented by potentially disappeared fraction of species (PDF), which is the pressures which is generated by companies on nature. That's on the x-axis. On the y-axis, we have how are companies dependent on inputs from nature. That's what you see on the y-axis. If you look into the top right-hand quadrant, those are the companies which have highest impacts and highest dependencies. So if you are a portfolio manager, you would ideally would like to just look into that quadrant and say, which are the companies in my portfolio which has highest impacts, but they also have highest dependency on nature. And if you and actually the size of the bubble uh, represents the amount of investment which you have done in the company, and the color of the dot actually represents how significant their exposure is to sensitive locations. So are they also operating in geographies which are really sensitive? So all of this information has been compressed in this one chart. And one key observation which we had was there were two sectors which stood out. One was manufacturing, and it includes a broad mix of manufacturing companies, chemical, cosmetics, pharmaceuticals. But at the same time, logistics companies also stood out. So there were quite a few logistics companies, paper and pulp manufacturing companies. So these were the hotspots in my opinion. And you can see, this top right-hand quadrant, which was the real hotspot, which we identified. Um, so from an engagement standpoint, I would say the top, these dots which you see in extreme right and top and side, those would be the first few companies which we would recommend financial, in this particular case, store brand to go and engage with.
So for the non-scientists in the room, like me, how does GIST impact actually quantify a biodiversity footprint for a really large portfolio? I know you have really interesting, um, the potentially disappeared fraction of species is one, the land conversion equivalence is another. I'd love just a little, definition of those and how you've been using them.
Yeah, I think PDF, which is potentially disappeared fractional species, is not a measurement metric which just has created. It has always existed in scientific research. In fact, um, you will find references to this indicator going back to 1995. So, almost 20 years, more than 20 years have been spent in developing this metric. So it's not a it's a very scientific and robust approach to look into uh, uh, the pressures which is generated by the companies. Um, and if I take an example, typically if we look into carbon footprint, we would look into the emissions which the company has done in terms of GHG emissions in CO2, methane, nitrous oxide, and all the other GHG gases. But in case of nature, we can't just look into impacts on nature by using GHG. We have to expand the lens beyond GHG, and that's where we have to look into water, we have to look into nitrogen, we have to look into phosphorus, we have to look into land use change. PDF is a methodology which allows us to aggregate the impacts of all these pressures into a single number, and it is based on a very um, robust scientific underpinning methodology. And we use a open source model called LC Impact. It's highly cited, more than 2,600 citations for this approach, which essentially is converting all these pressures into a single metric, which represents if these pressures were imparted on species, what is the likelihood that there will be a fraction of species which is expected to go extinct? Or um, in other words, we can say that, what is the likelihood that species will not be able to survive or thrive in the geographies or the regions in which the company is operating in? A way to represent the PDF number is to use a indicator called LCE, which is land conversion equivalence. It is nothing but representing the same PDF number, which typically is in scientific notations. You will find numbers being 2 into 10 to the power minus 7 to 2 into 10 to the power minus 5, which is very difficult for a FI financial institution to interpret and understand. So what we did, we use equivalencies similar to carbon equivalencies, saying that if the same size of impact was to be driven by a company across all the pressure categories, but we would use land use as a proxy, saying that the same impact's been driven by a size of land which needs to be converted into barren land, what would be the size which will have the same impacts? And that's the LC metric, saying a company led to a land conversion equivalent of 5 kilometers square is is basically representing that the impacts which were driven by the companies across all the pressure categories is equivalent to clearing of a land size of 5 kilometers squares. We are just trying to make the metric more understandable and easier to interpret for the financial institution using this metric called LC.
So almost how much land would you have to pave over to represent the impact of
Yes,
this
but
company?
but the impacts is driven by all the other drivers, including
Yeah,
GHG, water, etc.
right. Okay, well, kind of edging towards the end of this more fireside chat here, what the GIST impact learned throughout this project? What's the biggest thing?
And quite a few learning. I would say again, the data is not perfect. I shouldn't say that we have the perfect data, but the biggest learning is that we have enough data to start investigating, start doing the work. It will give us very tangible insights, and we were actually ourselves very very surprised with some of the insights which we got from the analysis, especially when you start bringing multiple dimensions together. I think that was one key learning. There are areas of improvements, as you know, we all would know. I think one key area which stood out was knowing more about the assets of the companies. That um, yes, we can look into the different types of assets which the companies are operating from, whether it's manufacturing or office operation, or but you know, we would definitely like to have more information on the assets itself. What's the volume of production, what exactly they are doing at these assets. Although they are being tagged as a manufacturing unit, they might not be. They might be intermediary processing plant. They might not be critical manufacturing assets for the company. So how do we put materiality to these assets which we have for these companies? I think that's a key gap which we are working on.
Hear that. And for store brand, now that the analysis is public, what are they going to do with this information? What's the call to action as well for investors who
I think quite a few clear action steps from their side. I mean, this study gives them at least some level of confidence that they can, in a more quantitative way, start integrating nature into their decision making. Not that they are not doing it already, but it gives them a very clear quantitative evidence. They are able to cover all the dimensions which is necessary. The second would be, engagement. As we looked into, those 100 companies, clearly some companies stood out than others. It gives a very clear indication of which companies can be engaged with. So it also reinforced the hypothesis that, this kind of study can be used to narrow down the most problematic companies in your portfolio. The real value is to engage with these companies and talk to them and see how they're addressing these challenges over time. So yeah, I think engagement and reinforcing the thought process of integrating nature into decision making. I think those two were the key insights which we got. Yes.
Yeah, I'd be curious to get them in here next time and see how they're engaging and what strategies they're using to make sure that actually those impacts are being reduced. Um, but thank you so much, Anupam. Really appreciate you walking us through this report. What I'm going to do now is allow all of the participants to unmute themselves and open up this portion now for the Q&A essentially. So I myself am kind of going back to the gallery of faces that Zoom allows us. And of course, I have a ton of questions that I've collected before the webinar. I can pull upon those. But before I do that, I was wondering if anyone had anything top of mind. I'll leave a few seconds here for anyone to raise their hand. Yes, Christian. Hi.
Hi there. Thank you for the presentation. And a quick question on the potential companies who would be willing to do more. Do you see anything as a sector or a size where you think that there is a tendency to kind of invest more into climate or carbon?
Yeah, I think definitely, Christian. We have been carbon tunneling is an issue. I mean, it is a really important driver. I mean, I'm not saying that. I mean, in our own analysis, we see almost more than 50% of the impact for a typical company, which is not in primary or secondary activities. They carbon would be the biggest driver of impact. But um, you know, nitrogen, phosphorus, these are some of the very important drivers and pressures. And it's also significant for different ecosystems. So, we talk about terrestrial ecosystem, you will find water is a big driver of nature loss. But then when it comes to aquatic and marine ecosystem, nitrogen and phosphorus becomes so critical. Added volume of nitrogen in aquatic ecosystem leads to significant changes in the habitat. Phosphorus in marine ecosystem leads to significant changes. So these KPIs are also very nuanced from which ecosystem type we are looking into. And going back to your question, Christian, I think there are some very specific sectors like paper and pulp, known to have big challenges, not only from carbon, but there could be captive forest, plantations which they can maintain, but also paper and pulp craft process leads to significant waste generation. The concentration of the nitrogen, phosphorus, COD, BOD, these pollutants which are there is so significant that if the companies are not taking the right steps for managing it, it becomes really problematic. The other example would be, which I would like to uh, uh, take is aquaculture, especially from Nordics standpoint. Um, you know, again, nitrogen, phosphorus waste is very significant to clean water, which is needed to maintain those aquacultures. If the right technologies are not used for wastewater treatment in those units, it can lead to very significant impacts. And there is then this whole species dimension and diversity dimension, which is much more complicated to address. I hope I addressed your question, Christian.
Thank you.
And I was just trying to think, you're not a Nordic company, you're a Baltic company, Arbonics, but probably
We
related.
actually both. We are starting from the Baltics now, are also in the Nordics and UK. So this is the water basin between the countries is a very important element in nature as well, where like the ecosystem in as a like a general unit plays a huge role.
Absolutely. Well, thanks for your question. Hariana, I see you're in the room, so maybe I can read your question out loud. The question,
Yeah,
Anupam.
go ahead, because I don't have it.
Yeah, no problem.
I don't have it.
It's how does satellite-derived biomass and land use change data fit into the biodiversity footprint picture, particularly for forest risk commodities in food production?
Yeah, I think so from biomass standpoint, the end, there are model called I'm forgetting the name of the model. But essentially there are satellite data sets which can help us to assess the volume of biomass in particular geographies. Those are coarse ways to look into the overall biomass which is sequestered in a particular area. When it comes to footprinting, I think the footprinting approach is more focused on inside out impact of the businesses on nature. So, the focus is more on the pressure categories. But one of the pressure categories is actually land use change. And there we use satellite data quite extensively. For example, we have processed entire global land use land cover at a resolution of 100 meters square. So for every 100 meters square land patch, we can tell among 56 different categories what is the current land use and land cover is. Now, how do we use that data? We would use time series analysis of those satellite images. So we would look into a snapshot for 2020, 21, 22, 23. And we would look into the last 5 years trends, that how the forest patches have changed over time. And for every pixel of 100 by 100 meters square, we would highlight that this pixel has shown the biggest loss of forest over time. Now, the moment we overlay the asset locations of companies on that data set, we are able, and we are not sort of making any conclusions here that the company's operations are leading to these changes to forest, but it's really important for us to investigate that these companies which are in the same business activities which can lead to forest change are operating in these areas, and those areas are showing significant losses over time. Then it's a clue for financial institutions to go and engage. If companies in paper and pulp have assets and plantation in those geographies, and those areas have shown significant degradation over time, it's a point for investigation. So these are the ways which we have been using satellite data for a lot of work which we have been doing, especially from a deforestation standpoint, and from commodities standpoint, we have a partnership with Global Canopy, who provides us very significantly detailed data on which are the companies which have been directly known to have linkages with commodities, which leads to significant deforestation. Palm oil, beef, these are the uh, key commodities.
Okay, thank you.
Sean, go ahead.
Hi, thank you very much, and thank you, Anupam, for that excellent presentation. Amazing work. And forgive me, a second thing I'd like to start off by saying is I was actually driving in a car and I missed a lot of what was said in the beginning. So if my question seems off, forgive me, but I think it's worth the risk of asking anyways. I see in the corner of your what is it called behind you? Anyways, there's a screen behind you that says measure value and manage your impacts, risks, and opportunities. One of the things we're trying to do at UNDP is marry this area of work, natural capital accounting, with work being done on measuring impacts and dependencies. Have you been able to, maybe not in this case study, but in others, demonstrate with real either dollar or rupiah or yen figure how much natural capital stock and what value of it is being put at risk, either put at risk and or in fact damaged? Have you been able to come up with a methodology for doing that? Thank you.
Yes, you'll be actually delighted to know, Sean, that our CEO Pawan Sukhdev was a study leader for TEEB, the Economics for Ecosystem and Biodiversity, and that's how we started. So it is definitely a topic which we have worked on for more than 15 years now. I've been engaged very deeply with the work with Capitals Coalition, TCA, True Value Accounting, accelerator programs. So yes, fully aligned, and that is one key area which we have been pushing for the last 15 odd years. That there's a lot of free services which nature provides. If we use simple economic proxies by saying that look into the abatement cost, look into the mitigation cost, look into the replacement cost. These free ecosystem services has a lot of value, and nature is providing that for free. If companies do not invest in maintaining what is called as environmental infrastructure, these flows of ecosystem services are going to stop. We are already seeing significant reduction, and companies will have to eventually pay for these free services by putting in human interventions, which does the same job, but we do it through human intervention. Going back to your specific question, has someone used natural capital lens for doing the portfolio analysis? I'll take two very good examples. Even in Storybrand report, we use natural capital lens. The damages which the business operations can potentially have to society, using economic proxies as a approach to value those damages, and most of them are typically negative. But one very important example which I would like to highlight is Norges Bank Investment Management. And the reason why I highlight NBIM is they have done it at scale. I mean, they analyze their 8,500 companies portfolio using natural capital impacts as a lens. So this question that this cannot be done, this cannot be done at scale, it's no longer valid, because one of the largest wealth sovereign wealth fund has already done it for their entire portfolio of close to 8,000 listed entities, and they use natural capital impact as a lens. One of the best part about their analysis is that they would use natural capital impacts as thresholds. They have sectoral thresholds which they have created for the companies in which the sectors in which they invest, and they would identify the outlier companies in their investment portfolio, and that's one of the clues which they would use for engagement. And and even basically it's narrowing down the problem in their portfolio. So yes, we have been able to do it, but still, we would like more and more financial institutions to adopt this approach.
Thank you very much.
Thank you. One of the other questions, speaking of Capitals Coalition, is from Lenka Moore. Her question was, is Storebrand including impact valuation in their capital allocation policies in any shape or form?
I think it is a question related to what Sean has just raised. How do we use natural capital impacts as a lens to potentially tilt portfolios, to tilt the investment decision making? I cannot say that it is already being used extensively at Storebrand, but surely, they are quite keen to look into this aspect. Um, uh, Ultimately, the argument is very simple. What we are saying is that if in your portfolio you have companies which have massively negative externalities or third-party impacts, you are sitting with massive negative hidden risk, and these risks are going to internalize over time. And the time horizon of this risk internalization is getting shorter given the challenges which we are seeing. So more loss of biodiversity integrity and natural capital, the likelihood of internalization becomes more real and more immediate. So from an investment standpoint, given a choice, if you were supposed to choose between two companies with the same risk and rewards from financial term, would you not pick the company which has lower hidden externalities? And I think that choice would make complete sense to a pure investor, a pure portfolio manager. I don't think they should be thinking it twice. So it's all about risk management, I would say.
Yeah. Thank you. I'm going to leave 1 or 2 seconds of space to see if anyone else has raised hands. Otherwise, I have a ton of other questions. Anupam, you have the list as well. Are there any ones in particular that you're really interested in answering there?
I think I would like to use the AI integration as a question. I mean, how this space has evolved significantly because of AI. I mean, there are pros and cons. We all know, energy and water nexus is a big challenge of AI adoption. Um, there are challenges to human capital, how AI is driving concentration of capital in produce capital, in financial capital, and shifting the capital away from human capital, which is employee, because the key approach which has been used by most of the companies using AI integration is to reduce their employee count. So there is a big negative human capital impact of AI, which is shifting the human capital to produce capital, which is financial capital for very few selected companies out there. But from a nature lens, I think it has helped us accelerate a lot of work which we do. We are now able to capture as many as 500 quantitative and qualitative data points for almost 20,000 companies across the globe using AI. It does such a brilliant job. We are able to trace back the original source from where this information is picked. All of this was possible earlier, but there was a lot of human manual intervention involved. Now, we have been able to reduce manual intervention in the process. Other good example which I would like to mention is how satellite images are being used to train through AI, visual AI models. So for example, one of the key use cases which we are currently exploring is how we can do asset verification using satellite images. So if we know that this company sees that this is a mining asset, we would use satellite images to see if that asset also shows features of a mine. And you can actually train a AI machine learning model so that it goes in our entire database of 4 million asset locations and filter out the assets which actually looks like mine, and they have been tagged as a mine or not. So it is kind of helping us to validate the asset locations which we have in our database. So very good, very advanced use cases of AI um, on our side, which is ultimately helping financial institutions.
Makes a ton of sense, yeah. Well, speaking of data and AI, what are the data sources that are being used? Carl from the Nature Data Lab, I think, Carl Burkhart, says there's huge disagreement on biomass models. But of course, in the Nature Tech Collective, that's always the biggest question. What's the data source?
I think one thing which GIST has done, which I would like to highlight, is our NGO partnerships. So there are different levels of data. There's primary data, there's secondary data, there's tertiary data points, and we would use and leverage all of those different data sets. Primary data is primarily being driven by our partnerships from our NGO. So we have partnership with IBAT, which is in itself a consortium of 4 NGOs, UNEP, WCMC, Conservation International, BirdLife International, and IUCN. So they have been collecting on-ground data on nature and biodiversity for more than 40, 50 years. So there's a lot of data which they have collected on ground truthed, which we get access to. And that's IBAT. We have partnership with Global Canopy. We have partnership with Natural History Museum. And recently we had a partnership with Hub Ocean, who are collecting similar data on ocean and marine ecosystem. So, there's a lot of focus on terrestrial ecosystem, but now we are also embedding primary data on oceans and marine ecosystems. So we are heavily relying on NGOs who have been doing excellent job in capturing this information. We are leveraging that data in our analysis through the partnerships which we have. Second is the data which we collect on the companies itself. As I mentioned, we would track the data which companies report for 20,000 companies, time horizon for 10 years, more than 500 KPIs. That's the data which we expect companies to publish, but if they don't publish, we would gap fill using models. And then tertiary data sets like satellite information. There's a lot of satellite information which is available. We would use a lot of processing of these satellite images is done in-house. We know how to process this information and derive the right insights. For example, deforestation example, which I gave. So it's a combination of different types of data set, but ultimately we are bringing all this data together for the analysis which we are doing for a company or a financial institution.
Thank you for that breakdown. There's a question from Nico Carlos Robles from the Nature Finance Accelerator, which you might not have an answer to, but is interesting. What motivates asset managers to care about nature, and how does this translate into investment commitments? But especially, have you seen cases where lack of nature data led to divestment?
Yeah, I think the business case is very clear. It's risk management. If you're not addressing these risks, it is going to impact your portfolios going forward. And earlier, one thing which stood out in some of the conversations was diversification has been used primarily as a way to reduce risk by most of the asset managers and financial institutions. But the reality is that the same approach is giving them massive exposure from nature and biodiversity standpoint. So, since they have diverse assets and diversified locations in which they have invested, they are also exposed to significant risk from nature because of their exposure becomes global in a way if they are exposed to emerging markets as well as developed market and different asset classes. So diversification, which was a risk management approach from a financial standpoint, it does just the opposite from nature and biodiversity standpoint. So that is a very critical point which I would like to highlight. And financial institutions have to understand this better going forward. The second point which I would like to mention is, so as I said, it's all about risk management. Um, um, on the point of you know um, divestment, I think divestment is not the way forward, and this is what we hear from a lot of financial institutions which we work with. Their immediate next step is engagement. How do we highlight the problems to the companies, because for companies also a lot of these problems are quite new. Give them some time, couple of years for them to respond to the problems which has been raised, whether they are taking the right actions to address those issues or not. And if they don't respond and they don't act, then divestment is the last step which can be taken. But eventually which I hear, and which is the right approach taken by financial institutions, is how can they become a force to change these companies. And I think they definitely have the ability to bring changes to companies, how the companies work. So engagement would be the first step. And then if they don't respond, then divestment. There are some exclusionary criteria, which is definitely there. For example, in case of Storer brand, they have very strict criteria, which they do not engage with such companies, which should also be there. So that we are de-incentivizing certain business segments, business activities, which is so critical as well. So yeah, engagement plus divestment as the last approach, I think.
Thank you so much. All right, let's see. Is there a last question that we can fit in? Is there a last question that you're interested in talking about, Anupam, or is there a last question that this audience has?
Any questions which the audience would like to?
I think the audience is just enjoying your thoughts on the questions that were posed.
I think
maybe
there was a question on standards and framework, that does it drive the right
Right. Do standards and frameworks truly change corporate behavior, or do they create perverse incentives? That one's by George Kelly of Earth Recovery Partners.
Yeah.
Thoughts on that?
I think my thought is that definitely it helps and moves the companies in the positive direction, because without these standards and frameworks, disclosing information, in my opinion, is the first step. And there's a quote which says, you cannot manage what you can't measure. So companies have to start measuring these aspects, these material topics which is relevant for their operations. And many times companies are not aware of what their relevant topics are. So doing that analysis, under these standards and framework, they start evaluating whether they have a significant materiality across these topics or not. I think that's a first step. Once they have done the materiality assessment, they start disclosing on those topics. And while they start disclosing, they also learn a lot about their own operations. If a company start disclosing on total nitrogen in a particular year, they would know, what are the business, production lines which are leading to those emissions. What are the activities which are leading to those emissions? Is there a incentive for them to put abatement technologies in their operations? So companies would learn a lot simply from the measurement step which they are doing. And then after they have done the measurement, once they have some time series data on the measurement, they start seeing whether they are doing good, bad, or they are improving. So actions can only come once they start disclosing. And this also gives very good information for financial institutions to go and engage with companies. So I would 100% agree that standards and frameworks are supporting the cause. GRI, for example, without GRI, we would not have the data which we are capturing today. What they initiated 20 years back, CDP, GRI, these are the organizations would have played a very important role.
Yeah. Yeah, the mantras in this sector are, nature data knowledge is power and perfect is the enemy of good. Well, thank you so much. I think this is a good place to close. Thank you for sharing your knowledge about this report, about this sector. You've been with Just Impact for a long time now, actually. So really great to hear your perspective. Thank you to the audience for being here, for posing questions as well as you registered. A lot of you are here are part of the Nature Tech Collective, so you're all able to connect on Slack, etc. And if you're not, of course, you're invited to join. Thank you so much. That's what I have to say. The next webinar is coming up soon, and we'll let you know when. You'll get an invitation.